Okay, welcome to Chapter 1. These are the learning goals we have on Chapter 1. We want to understand what investments are, the process of investments, principal types of different investments you can make, steps in investing, common short-term investments, and describe some of the careers that people can possibly have in investing. All right. So the first question is, what is an investment? And I think everybody has kind of the answer to this question. Is you put your money into something and you're hoping for a return, a positive return. Maybe income or increased value of the investment. Right now, everybody in this classroom is making a big investment in their life, and it's college. So pursuing a business minor or major is a huge investment. You are spending thousands of dollars on this investment. And you want to think of it as an investment because why? What's going to happen after you graduate? You're going to have a life where you're going to earn $1 to $2 million of extra income over someone who does not have a college degree. So this investment, maybe it's $40,000, maybe it's $80,000 you're spending on this education. That's a lot of money, but how is that in comparison to $2 million of extra possible top-end earnings from having a college degree? It's a pretty awesome return. And that's why so many people go into debt, spend a lot of their time and effort trying to get a college degree because there is a specific return. And that's an investment that you have to keep that in your mind, that I'm in school now because I'm going to get a return for all this effort. I don't think anybody here particularly enjoys every day getting up, commuting here, or dorming here, going to class, doing homework. Sometimes you enjoy it, but overall it's a huge amount of work. And you're doing it because it's an investment in your future. And so if you think of school as investment and why you're doing it and come to terms with that, pretty much what we're doing in this class is just a small subset of that. And we all want to, make the right choices and get the best return. So there are different stocks you can invest in. Some have better returns than others. But you have to look at all of the variables. Just like you're going to school here at Stony Brook, there are many variables that got you here to Stony Brook. Why choose Stony Brook? What the advantages to you? There could be scholarships. You could be on a sports team. It could be a location to where you live. I mean, there are many different reasons for why you're here. But everybody's here for one ultimate goal, and that is return of their investment. Now, when we look at different investments, as far as what we're going to talk about in this class, mostly it's about securities or property. Stocks, which are also, stocks, bonds, and options are also known by the term securities. But there's also real property, like land or buildings. Real estate can be an investment. We also talk about gold, artwork, collectibles. When I was younger, I had in my possession a Hulk 181. Does anybody know why that's a key issue? Hulk 181. Bought it for $100. Why is that a key issue? First appearance of Wolverine. That same comic is worth close to $3,000 today. The only comic I owned that was worth any money, pretty much everything else I bought was worth garbage and I had to throw out anyway. But that one had investment potential because first appearance of any major character generally has a good return. That's an example of collectibles. And there's a lot of shows now that do collectibles. Antique Roadshow. You have the Pawn, Las Vegas Pawn. What Pawn Stars, or not porn, like sexual porn, but porn, like people come in, I want to sell this old thing I found, and then they discover it's worth a lot of money. Collectibles, antiques. Gold is a huge investment right now. People who are worried about the global economies and currencies, gold is a tangible personal property. So these are all types of investments. Now, some investments can be direct, buying a direct stock ownership, buying direct gold, holding an ounce of gold, having your own house and real estate. Those are direct investments. Some can be indirect. If you buy through a mutual fund, that's an indirect investment. You're giving money to somebody who's going ahead and turning it and buying other investments for you. Now, stock ownership As far as the United States, we have the highest percentage of direct stock ownership inside of our household. So 30% of American households own stock. And that is a pretty high percentage compared to the rest of the world. Our stock markets are the largest stock markets in the world and hold about 40% of the world's stock market value. And we're somewhat of a stock-obsessed culture or country where we talk about stocks. Stock market movements are big news. There's a lot of print and magazines and books devoted to stock investing. Now, other such things, there are debt equity or derivative securities. Debt is a type of investment which involves loaning money to somebody and getting paid back at a later date with interest. And particularly the big investments in the debt areas are bonds, government bonds, corporate bonds. Equity is another term for stocks, common stocks. So when they talk about equities, if you hear that term, they're really talking about stocks. And this is direct ownership in a company. If you like a company, you feel like this company is going to do well, you purchase it and hope for the best. And speaking of companies, Under Armour is a company I was invested in long ago and has done fantastic. And how did I find out about that company? Well, it was basically looking at students in the class who wear T-shirts and hats and shirts that say Under Armour on it. And that was a clue that this was an apparel company that started becoming popular. It's the same thing I did with iPods. As soon as students had all these Apple iPods, I figured out that Apple would probably be a good stock to invest in. There's been a certain amount of occasions where college students are on the forefront of the next great product. They're usually early adopters. So if I see a particular brand of clothes or electronic device or computer, when a follow-up to that is when I started seeing less and less IBM PCs and more iPads and Macintosh laptops in class. I got the impression that Apple's going to be a much bigger company than I expected. So that is just when it comes to stocks, sometimes it's just as simple as recognizing when a product's becoming big. You're going to the mall and seeing that, wow, this store is very busy. I wonder who owns the store if I could buy shares in it. It's your first visit to Starbucks. I don't know if you can remember this because they've been around for a while now, but your first visit to Starbucks when you say, I can't imagine why anybody would pay $4 for a cup of coffee, and you go into Starbucks and there's a line of people just waiting to pay $4 or $5 for coffee or mocha lattes or all those frappuccinos. They were made a great business model. So if you could recognize what good businesses are, that are hopefully you can get there early before everybody else. The earlier you can recognize it, invest in it, the better the investment. We also have in this area derivative securities. We're going to talk mostly about options in this class, but derivative securities are not debt or equity, but they can be based on any investment. So they're derived from another asset. That's why they call it derivative. And we're going to be talking mostly about options, but there are also futures, forwards, and swaps in this category. And a big attribute of investments is risk. Low risk or high risk. We want, ideally, low risk and very high returns. That's what would be the best for us. Can't always get that. Sometimes we'll settle for moderate risk and high returns. But what we don't want is high risk and very low returns. So when we look at investments, there could be short-term and long-term investments. Some bonds are good for 1 year. They're called short-term bonds. Anything that would have a maturity within 1 year. Long-term investments are anything that are greater than a year, and typically all stocks and equity are considered long-term. And you have your basic domestic or foreign. Domestic would be U.S.-based companies, and of course foreign would be foreign companies. And there's a lot of potential growth in foreign stocks. International stocks. China has been an area for extreme growth in equities over the last 20 years and having better stock market returns than the U.S. stock market, which is a more mature market and has more mature returns. So everyone's portfolio these days should consider or should contain some foreign stocks inside their portfolio. All right. Suppliers and demanders of funds. The government, which you may realize they're in deficit or have a national debt, so they're a demander of funds. They need funds. They need money to support this huge government and all the borrowing they do. Businesses are also a demander of funds. Businesses borrow a lot of money, issue a lot of stock. They need money to expand, to make mergers and acquisitions. So where does all this money come from that the government and businesses use? It comes from us, the individuals, the citizens. We save our money. Sometimes we borrow money too to buy a car or a house. But by and large, in the aggregate, we're mostly savers, and the money we save, we invest in treasuries and stocks and transfer the money to businesses and government. Okay, and this is a graphic of sort of we're the suppliers of funds. Let's see. Over here, we're the suppliers of funds, and we bring our money to the financial institutions, the banks, the savings and loans, investment companies, pension funds, 401k plans, and they take our money and they move it to the demanders of funds, who are going to be the government and businesses. So the financial markets are actually the way the money moves. You bring the money to the bank brings it to the financial markets, and then the returns of the money go back to the bank, which you can take out of at a significant point of time. So this is the way that the money kind of just, a simple graphic of how the money flows around the economy. So we save it, and financial institutions and financial markets help us to invest in government and businesses through bonds and stocks. They get their money to expand their business, hopefully grow, and we get a return in interest or in stock price appreciation or dividends. And there are two types of investors. So we have the individual investor, which invests for personal financial goals and savings, retirement, to buy a house, to become super wealthy. And we have the institutional investors. You actually may work as an institutional investor. These are people who are paid to manage other people's money. They trade large volumes of securities. They could work for banks, investment banks, insurance companies, mutual funds, pension funds, and they basically professionally go out, try to figure out what would be the best stock or investment to make for my mutual fund or pension fund, or and we basically have the expertise, the education, the experience to make these investments on behalf of other investors who don't have the knowledge, are afraid to actually buy anything themselves. So they'll rely on the institutional investors who will basically professionally make these trades and these ideas and concepts of where to invest. Now, the short-term investments, well, we talked about this before, they're usually very high quality, very liquid. A short-term investment could be considered a savings account, certificate of deposit, a CD that lasts for 1 year or less. And very safe, low risk, and low return. Common stocks represent a longer-term investment, ownership in a company whose returns are typically the best of any investment. Over time, stocks have returned the most, more than bonds, more than real estate, if we look at a long-term picture of them. And then the fixed-end securities, fixed income securities, are the bonds, convertible securities, preferred stock. And these are basically, you lend somebody money, they pay you interest, and when the bond is due, you get the money back. So you all understand the concept. You're making a loan to a business or a government. Okay. The types of investments that, if you're not buying individual stocks, you may want to buy a mutual fund. We all understand the basics of mutual funds. We're going to go over this later in this course. They're professionally managed portfolios of stocks that you can invest in. So if you don't know, if you're not sure what 20 stocks to buy, you can buy a mutual fund instead, and professional money managers will buy these funds for you. There's also what's called ETF, exchange traded funds. And these are like mutual funds, but they trade more like a stock. So again, they're a group of, somebody puts together a group of stocks and then sells it back to the public. But they trade, they're generally unmanaged, so they're just the same group of stocks, and they trade exactly identical to a stock. You can buy and sell them during the day, you can sell them short, you can apply leverage to them. Where a mutual fund, when you purchase a mutual fund, you have to wait till the end of the day for it to be purchased, and you have to wait for the price to be calculated at the end of the day. You can't buy it intraday. And then we have the hedge funds, which has gotten a lot of popularity lately because of the extreme returns. And the hedge funds are primarily for a different kind of investor, a large investor who meets the minimum. Sometimes you need $1 million or $10 million to be part of a hedge fund. They're not as heavily regulated by the government as mutual funds are, and they can do much riskier trades and apply much riskier trading ideas and mathematics to try to make a much larger return. So right now, the hedge funds are primarily an instrument for the very rich. We have derivatives, which are for you in this class, and for most ordinary investors, the only derivative you can trade is an option, a stock option. There's a whole chapter where we're going to go over that. And of course, again, real estate and other tangible assets can be investments, collectibles, like we were talking about before, real estate, artwork, things of that nature. This is just a page from the textbook that you can actually go to the textbook if you wanted more specific examples of these types of investments. Okay, so some point in your life, maybe you want to start investing, and you have some extra money. You've graduated from school, you've paid back your student loans, you have a secure job, and suddenly you're accumulating some savings. You have your new car, maybe you even purchased your house, or somehow you have a pile of money that you don't really need right away, but you'd like to make a decent return on it. You're not satisfied with 0.025% interest in the savings account, and you want to make a better return, right? So you decide, I want to invest. Step one is meeting the prerequisites, just like some of your courses in college. So you have to have your quality of life covered as far as your emergency cash in case you get laid off, as far as being able to cover unexpected costs that may occur in your life, illness, death, disability. I mean, you want to have a certain cushion of money, usually they say 6 months of your income, just as a backup before you start investing. Most people don't follow the advice of step one. They just have some extra money and they invest it. They don't really worry about having that much money in the bank. But it's usually common advice that you have some sort of backup fund just in case. So you don't have, because the idea is you don't want to start selling your stocks because you have to. You want to sell your stocks when it's the best time to sell them, not because you need them to pay for something. And then you have to establish in step two investment goals. Why are you investing? Are you investing to retire early? Do you want to invest enough money that you could retire at 50 instead of 65? Or in your case, if you're under 25 today, you may be working until you're 70. But don't worry, your life expectancy is 100. So you still have 30 years of retirement. You want to just maybe enhance your income. So maybe you want to have some investments that can throw off dividends and interest that, if you're about to retire, maybe you want your investments to throw off some supplemental income. Or maybe you don't want to work anymore and you just want your investments to generate enough income that you can work, that you can live off every month. Sometimes investments people want to make them as tax shelters. So they want to invest, they want to make sure that they want to shelter their extra income from taxes. So you're able to, through a 401k, save up to $17,500 tax-free. So you say, okay, I make enough money to live on. I have $17,000 of my income that I could easily put into a 401k plan and not pay any taxes on it. If I save it in the 401k plan, I see the $17,500 in the 401k 100%. If I took that out and got paid that directly, that might only be $10,000 in my savings account after I pay taxes and Social Security on it. So sometimes looking at the tax advantages of investing are a good motivation to start investing. And in fact, when you graduate, the first thing you should do if you get a company that has a 401k is to contribute the maximum amount that you can afford into that 401k. And I'll show you later on in the class what investments to make inside that 401k to make sure that when you retire, you'll have at least $10 million to retire on. And I'll do the math to show you how that works. And if you only get that from this class, then that's enough, because that sets you up for a very lucrative retirement. Step 3, adopting an investment plan. You want to plan this out and sort of have a target date, how much risk you're willing to accept for your goals. And this should be something that you write down and you think about. Like, do I want a very risky portfolio? How long am I going to invest for? Just really kind of think out what you're doing. In step 4, you want to evaluate different investments. So now that you know the level of what type of investment plan you have, you can start looking at potential investments, different risks and returns. We'll cover more of this in chapter 4, but you need to evaluate all these investments that are out there: mutual funds, ETFs, hedge funds, individual stocks, bonds, options. What is the right mix for me and what I'm trying to achieve? And that's something that we'll learn during the class. Step 5, selecting suitable investments. Now that you know that you've evaluated and know the different investments out there, how do I get the right group of these investments for my portfolio? And how do I make these investment selections? How do I know which stock is the best, which bond is the best? How do I know how the economy relates to returns, and when is a good time to start buying stock, and when is a good time not to start buying stocks? And then using these to construct what we call a diversified portfolio. Making a portfolio where, like the common saying, you don't put all your eggs in one basket. That you have a portfolio that's diversified and helps protect your return and protect your investment. And then 7, managing this portfolio. At certain times, you may want to add a new investment to the portfolio or sell or take away an recurring investment. So times change, different companies come and go, and you're going to, and managing a portfolio may only take as little as 30 minutes a month or 20 hours a whole year to devote to managing your portfolio. If you really have things set up well and you're confident with your investment, you may only have to look into it every 6 months or once a year and kind of judge, if it's a portfolio of mutual funds, maybe evaluate once a year. Maybe there's one mutual fund that's constantly underperforming. You may want to sell that and buy a different mutual fund. But you certainly don't need to do that every month. Okay. So taxes are a big issue when it comes to investing. And the money that you keep is what's important. So for example, many of you, when you get your job and say the gross pay you make is $1,000 a week. You have a $52,000 a year job, and you're going to make $1,000 a week. How much of that is going to be in your actual paycheck? 600, 500, at the worst, maybe 500, 600, 700, maybe, depending on how you organize your taxes and your retirement, your exemptions, and things of this nature. So tax planning is an important part of investing, because you don't want to pay more to the government than you really need to, that you're legally obligated to. So you don't want to break any laws. You want to pay what you owe, but there's ways of manipulating, they're called loopholes, the tax system to pay less. So investments, because the government has opened up these loopholes in certain investment areas, because they want you to invest. They want to encourage your savings, so they've given you tax deductions. And things to think about: income you receive from investments will be taxed. Capital gains you receive from investments will be taxed. On the good side, though, whatever losses you make in the investment arena is a tax deduction. So if you lose money on an investment, you can actually take a tax deduction on that. Something you can't do when you lose money, say gambling, or maybe you could offset the gambling winnings. I'm not sure, but I'm not an expert on gambling. I never lose, so I don't know what happens when you lose in gambling. Now, basic sources of taxes in investing is we have our federal tax rates, which go anywhere from 10% to 36.6%. So we have these tax brackets or rates that when you make income, the more money you make, the higher amount of tax you pay. So that would generally be on your wages or your active income. But some of those tax brackets will also be involved in your investment income as well. So after your active income, whatever money you make in capital gains are going to be applied on top of that. So generally the money you make buying a stock low, selling it high, you maybe make $10,000 on a stock, you're going to pay the top tax bracket on that stock gains. So that's why it's important to really think about, how can I make sure I pay the least amount? And I'll show you that in a minute. But the 3 types of income: you can have active income. This is where most of your income will come from. And this is actively working, salaries and tips and even pensions. And you have your portfolio income, income from your investments, interest, dividends, and capital gains. Capital gains is basically, you buy the stock for one price, say $5. You sell it for $10 a share, or maybe sell it for $11 a share. That $6 difference is your capital gains, and you have to pay tax on that. You also have your passive income, which just could be from rent on real estate, royalties on patents, or maybe a limited partnership. Okay, so these are the tax brackets, and you can see that these were recently adjusted, I guess in 2012. So everybody makes, this is the percentage of tax you pay. So everybody, the first $8,700 everyone makes is going to be taxed at 10%. And then between $8,701 to $35,350, all the money in this bracket is going to be taxed at 15%. But we all pay 10% that never changes in the first, say, $8,000. Just because you made more than $8,000 doesn't mean you can suddenly have to pay more tax in this first $8,000. So we are all fitting into these tax brackets, and as we make more money, then we pay higher rates on the new money that we're making because it's progressive. So if we're lucky enough to make over $388,000, we're going to be in the new top bracket of 35% of our income goes to federal tax. Now don't forget, living in New York State, there's also New York State tax. If you live in the city or 5 boroughs, there's city tax. There's also FICA, which is, I think, 7.5%, which is Social Security tax, and there's also Medicaid tax. So these taxes add up pretty quickly. And then if you take out money for retirement, that's how you see you only get 50 cents on the dollar. You make $100, you only have $50 in your check. So that's why it's important to keep an eye on these taxes and take any tax deductions you can when you can take them. Now, ordinary income is taxed in those progressive rates. So active portfolio and passive income, they're going to be taxed at those progressive tax rates. And your rates go up as your income goes up. Now, capital gains or losses is what we're going to pay tax on the gains, and we can pay a tax deduction on the losses. So a capital asset is going to be property you own, including securities of personal residence or real estate, although real estate has their own separate tax laws in addition. So capital gain is the amount of money you make from the sale of the asset that's above the purchase price. The capital loss would be if you sell something at a loss. And that you'll be doing plenty of this in the stock market trading game. You'll be selling things at a profit, things at a loss, and you'll be accumulating capital gains and losses. They all get netted together at the end of the year. So you may have, $50,000 in capital gains, $10,000 in capital losses. So your new capital gains is $40,000 for the year because they net each other, and for tax purposes. Now, taxation of capital gains is okay. So if you hold the asset for less than a year, you're going to pay your ordinary taxes on it, which could be 30, 28, 35%. However, there are special rules if you hold the asset for less than a year. So if the capital asset is certain rules if you hold it more than a year. And that could be, your taxes could be 0, 15, or 20% if you hold the asset for more than a year. Now, these are the rules. If you hold the asset, because it depends on how much you make. So we're going to go over those income levels in a second. But the taxation of capital losses, you can use the capital losses to offset your gains, which is going to lower your taxes. And you have up to $3,000 a year where capital losses can offset your ordinary income. So say you lose $10,000. You made no money, you just lost $10,000. You can deduct $3,000 off your income. So instead of making $50,000 this year, it's going to look like you made $47,000. Now, the excess, the other $7,000 that you lost, you can apply again the next year. So you can always keep, but the maximum up to only $3,000. But you can keep reapplying that money moving forward until you use up all your capital losses, which is a good thing because you're not losing a full 100% of your money because you're getting at least a tax deduction out of it. Now, to qualify, we'll do a handout to kind of show you how to qualify for the 0, 15, or 20%. But basically, if your income is at a certain level, a very low-level income, and you hold the asset for more than a year, you'll pay no tax. The first threshold of income, if you hold it for more than a year, you may be limited to only 15% tax. So say your tax bracket is 30% or 35%, you're most likely going to be in a 20% capital gain. But if your tax bracket is only say 20% or 25%, then you could qualify for the 15% capital gains rate. So they have it prorated depending on how much you make. All right. Now, other tax consequences, and there's a handout that I'm going to be going over to really show you how this works. Other tax advantage retirement vehicles can be employer-sponsored 401k plans. So this is a vehicle where you work for a company and they say, we have a retirement plan, and you could take your money that you make at the company and put it into it tax-free. Up to $17,500 a year can go into this 401k tax-free. Well, federal and state tax-free. They still take FICA out on that. If you're self-employed, they have additional retirement vehicles that you could use that will reduce your taxes. And if you're an individual and you're not self-employed and you don't really have employment, like maybe today you're going to school, you don't have a job, you can contribute to an IRA tax-free. Or if you have a job making a low amount of money and there's no 401k available at your company, you can also contribute to an IRA, and they'll help lower your taxes. Now, as far as the investing life cycle, there's a concept that when you're younger, you want to invest more in stocks. And as you go to middle age, you want to consolidate and balance it a little bit more with bonds. And when you get to retirement age, you want to have it in the safest income-generating investments to limit your risk. So there is a cycle of different stages of your life, and how you invest will influence that. So it's a growth-oriented youth stage when you're younger, and this is pretty much common sense. I think you may have heard of this already, but you want to be invested mostly in high-risk, high-potential, high-return stocks to maximize your capital gains while you have the time to do that. And as you become middle-aged, you want to shift your portfolio into a less risky stance. Maybe include more bonds and fixed income securities. Overall, still have some investments in stocks, but maybe value stocks or blue chips. Some things are a little bit more safer and doesn't expose you to as much risk. Then in the retirement phase, of course, you want a portfolio that throws off a lot of income that you can live off of. So don't want to expose yourself to a lot of risk, like a 20% decline in stock markets. So it would be bad if you're retired. So you want to have a lower exposure to stocks and bigger exposure to income-generating investments. So in the income-oriented phase, there are certain bonds, low-risk stocks that pay decent dividends, and mutual funds that specialize in paying dividends and income that you can think of. And it's something as low-tech even as a certificate deposit where you just put your money in the bank and they have, they don't pay anything anymore these days, but when I was younger, they pay 8%, 5%, a decent percentage return. Now, when you're investing, one of the things that you have to worry about is this business cycle. And businesses over the last 200 years have had the cycle where there's a boom period where unemployment is low, business profits and business sales are growing, and then a decline phase where businesses decline, sales, revenues decline, unemployment increases, and the cycle goes in a downward turn and then turns up again. So we've had this business cycle for a long time. And we measure it by the economic indicators, gross domestic product, unemployment rates, things of that nature, to really get an idea of how the economy is doing. And if it's a strong economy, which is reflected by the business cycle, then stock prices tend to do well in a strong economy. So they rise, which makes sense, right? Businesses are doing better, they're making more profits, stock prices will go up. And they will fall during a declining business cycle. So we have a recession, which we saw our super recession in 2008, and we see stock prices dropping 50%. So this business cycle makes it really scary to invest in stocks because they're highly volatile. And many investors make the common mistake where they buy when times are good and sell when times are bad. But you need to reverse that. You need to buy when times are bad and prices are low, and if you're going to sell when times are good. Very hard to do. Very simple logic, but very difficult emotionally for people to do that. But bonds and fixed incomes are less affected by the business cycle. They are still affected because they're tied to interest rates, as are stocks and economic conditions. But generally, interest rates are, of course, tied to the business cycle. If the businesses are growing and money is getting tight, interest rates get raised. Inflation increases, and the downward business cycle where business is declining and the Fed is reducing interest rates decline. Now, bonds are typically a good balance to stocks, but what bonds are specifically related to is the movement of interest rates. So interest rates go up, bond prices go down, you lose money on the bond price. If interest rates go down, bond prices move up. So typically when a recession is starting, you move your money out of stocks and put them in bonds. Bonds will do well because they're going to start lowering the interest rates. And bonds will start moving up, the prices on bonds. So that's why a lot of people will switch between stocks and bonds during different parts of the business cycle. And we'll talk more about that. Liquidity is a big role too. You want to be able, the more liquid your investment is, the more valuable, the less risk you may have in that. So if you have a bank account, you could go at any time and withdraw that money. Very low risk. But if you have real estate, you put your money in a house, it could take 6 months to a year to sell that house. Very illiquid. So liquidity is something that you want to think about when you're making investments. How quickly can I turn this back to cash? And things that are very slow to turn back to cash hold additional risks. So advantages of short-term investments, they tend to be much more liquid and have low default rates or risk. And the disadvantages, of course, because they're less risky, lower rate of return, and a sensitivity to potential inflation risk. So that's probably the one risk you really have with these short-term investments would be inflation, which could also affect them greatly. So say you want to work in finance, anybody in this course is a finance concentration, or someone who's in, say, AMS or a related field to finance. Typically people who understand investments in finance well, they can work in commercial banking. And this is the part of the industry that services and creates a lot of financial products to work with people every day to open up bank accounts and mutual funds and mortgages and things like that. There's corporate finance, that's where I worked, where you have a broad understanding of business, functionality, financial statements, how to analyze corporate financial situations, capital budgeting, capital structure, and you help companies navigate and make good financial choices. There's financial planning, which is one of the fastest growing areas in hiring and finance. This is where you're hopefully a certified financial planner, and you help people plan their financial needs and meet their goals in the future. People who don't have the luxury of taking courses like this or having an education in finance. And there's also insurance. It hires a great deal of finance and math related fields such as AMS to come in and manage and involve and assess risk and asset management. So these are four big areas that typically people in finance work. Now, you may have heard this investment bank. It's not quite the bank at the end of your street. Investment bank is an organization that helps other businesses raise capital, produces IPOs, and a whole host of other capital-oriented expertise that the investment bank holds. And many of these investment banks are located in New York City. To get jobs in the investment bank area is particularly difficult because it's very competitive for those positions because they pay so much and the bonuses are very high and there's a huge potential for making a terrific amount of money. So they only employ the best of the best from the absolute best schools. Investment management, this would be managing money for clients, and you could be a CFA, which is a very high credential like a CPA, and this could be managing money not just for individual people but for clients. And this textbook will have specific questions and information about the CFA. In investment management, these CFAs generally work for other businesses on a more higher level in finance, and not so much for individual people. So that is the end of chapter 1.